Following the text and following the slideshow, the next accounts that we're going to talk about are accounts payable and notes payable. This is where we're going to really start digging into the different types of current liability accounts they are. I will be referencing back to some prior learning and will have uh, the additional use of slides from those particular lectures that I will go back over again during these types of situations. So these do dig in a little bit deeper. When we go into the actual classroom, I won't be going over these generalities, these things that are covered in the book, covered in the slides, things that you probably have already been experienced to. Instead, we'll really be discussing those secondary things. So just be aware and be prepared to watch as many of these as you feel is absolutely necessary, and watch them as many times as you feel is necessary. So, starting with accounts payable. These are what we call trade accounts payable. They are typically the balances that an entity is going to owe for goods, supplies, or services that were purchased on an open account. What is that? So, if you will remember back probably to ACC 121, we had the situation where we really started talking about accounts payables. When you read the words on account, purchased on account. Typically, you're going to use the accounts payable account. This is an agreement between one party or another, one party and another, that said party will provide goods or services, supplies, whatnot, to the other party. And in that secondary party will have a period of time to pay that off. Now, that could be 10 days, 20 days, 30 days, 60 days, 6 months. Depends upon the nature of the agreement between the two parties. Now, because there is a time lag between when you receive the goods or services, so you have purchased something from, let's use Office Depot for an example. That is an example most people are probably at least slightly aware of. You purchase office supplies from Office Depot. The supplies arrive on January 1st, but you don't have to pay for that invoice until, let's say, February 1st. Actually, January 31st. We'll say it's a 30-day term, so it's due on January 31st, where there's a time lag between when you've actually received title of those assets, you've received those supplies, you can use them, you can consume them, they belong to you, and when you actually have to pay for them. So, in order to balance the receipt of the assets in the books, we need to recognize the obligation that we owe to that vendor. Obligation equals liability. The terms of that sale, whether they're 10 days, 30 days, 60 days, 6 months, whatever the case may be, is going to help determine whether this is current or non current. 99.9% of the time, an accounts payable or a trades account is going to have a current classification tied to it. If it does not, that is the absolute exception, and I've not seen it. However, it may come into play at some point in our future. It's just remembering that it's those times. 1 year in operating cycle. Now, it may have a 18-month time frame on it, but if your operating cycle is 24 months, that is still going to make it current because it is less than the operating cycle. These types of accounts are going to typically have terms that are attached to them. And they represent, as you see here, 210 and 30, uh, 110 a month. Uh, they're going to state the period of credit, whether or not that's 30, 60 days, 6 months, whatever the case may be. How we handle these is a little bit different depending upon what method is chosen by the organization. So there are a couple of things you need to take into account for. And this actually throws us back to chapter 8. And I'm going to go ahead and I'm going to pull up the slideshow from chapter 8. As you can see here, we're looking at the chapter 8 slideshow. We're about a third of the way through it, give or take. And in this one, that's when we're talking about inventory. Now, although this talks about inventory, it can also apply to goods and services. It's the receipt of something of value. So, when we're thinking about that, we need to look at what point in time the passage of title occurs. Because passage of title doesn't always occur when you physically take control of a good. So, one of the things that you might want to think about is the FOB, uh, where goods pass title in transit. So, we're looking at during FOB shipping point, the ownership is going to pass when the seller yields the goods to the public carrier company. So, although you may not have the goods, your obligation may already exist. Or if it's FOB destination, that's the point at which you are going to have received the goods. And that's one thing that I'd like you to keep in mind because that date of obligation, that date of title transfer, is the date at which the obligation arises. When the obligation arises, we need to recognize it in our books for clear and transparent representation of the financial position of the company at a given point in time. So, moving forward through chapter 8, you may want to revisit this just generally as a refresher. Uh, but some of the things that we need to talk about is the purchase discounts. So, when I flip back to the chapter 13 PowerPoint, and the current liabilities, you'll see here we talk about the terms of sales, with the examples being 210 and 30 or 110 end of month. This is going to say whether or not there is a purchase discount. When there is a purchase discount at play, which we talked about in prior classes, uh, we then need to determine whether or not the company is using either the gross method or the net method. So we'll real quick go through an illustration of gross and net methods using the same situation. So here we have purchase of $10,000. The term is 210 and 30. So if we're using the gross method, so we're recognizing the receipt of the goods at the gross value. We'll recognize the increase to the assets of $10,000. Now, that could be supplies, or that could be the service you received, or that could be your inventory. And your obligation would also be recognized at $10,000. See here where we have recognized it as the accounts payable. Now, when we pay within the invoice period, we uh, paid 4,000 of it, so we have 4,000 decreasing. 2% of that is $80. So that is how much of a discount we received. So we have an additional $80 of purchase discounts that need to be taken into effect. And we'll only be paying $3,920. The remaining $6,000 is paid after the discount period. So a full $6,000 in cash is going to be remitted. Now, in the net method, this is making the presupposition that we will take advantage of all discounts. at the point of inception. So our purchases are actually going to be recognized at 9,800. This is a net of the discount. The discount of 2% of $10,000 is $200. So our accounts payable is going to represent at $9,800. When we pay the 3,920, it is already recognized that we have taken the discount. However, when we have to pay the remainder, we have 5,880 that is currently in the accounts payable account, but we need to pay 6,000. We need to recognize the purchase discounts lost, and then we'll have $6,000 in cash that we are remitting. Now, that's just a quick review pickup, so that way you remember to treat your purchase discounts and use the appropriate methods uh, depending upon what the situation is. Coming back to current liabilities, I just want to remind you purchase discounts and the point at which title actually changes hands. Those are the two things that you are going to want to keep in mind. So, notes payables. In this particular lecture, we're going to just generally kind of talk about notes payables because we will actually go into an expanded notes payable talking about interest bearing and non interest bearing notes in separate mini lectures. But keep in mind that notes are written promissories. So there is going to be a contractual obligation to pay a certain sum of money by a specified future date. Now, this date could be 30 days, 60 days, 90 days, 10 years. Whether they're classified as short term or current or long term is going to depend on that maturity date. Your short term or current obligations are assumed to going to be satisfied by a claim on current resources or assets or the creation of another current liability. Anything that is greater than the operating cycle or a year will be considered long term. Uh, Different types of notes payables that may come in are very short term ones you're using to finance shortfalls in cash during the non busy season until you come into a busier season. So let's take into account, for example, organizations like touristy types. And most people have at least visited a tourist location even if they haven't worked in one. However, here in the state of Colorado, especially the Western Slope region, whether you are in Steamboat, you are in Vail, you are in Carbondale, you are in Glenwood, you are in Aspen, you're in Buena Vista, you should have some type of an experience with the tourist economy. To give you a very specific example, let's think of hot springs. So, most hot springs, whether it's the Steamboat Hot Springs or it's the Glenwood Hot Springs, uh, have certain areas of the year in which they are not as active. One of those is actually in the winter months. They're more apt to be visited during the summer months because of the tourist location. They do get a little bit of movement in the winter months, but they tend to lose out on a large portion of the tourist dollar in the winter months to the ski attractions and also because it's cold. And although the hot springs are nice and warm, some people just don't necessarily understand how wonderful it is to sit in a nice hot spring outside while it's snowing. Um, but you know what? Bad luck for them. Better for us locals because the winter months are slower, so we can enjoy that with less tourists underfoot. Because of the nature of the cycle of business, the cycle of tourism. There are months where there is a slowdown to the cash flow entering an organization. When that happens, Many times, an organization will have a line of credit or they'll take out a short term loan in order to fund operations for those slow periods. And then they pay that off once they enter the busy season and cash flow is much more greater. So sometimes a current liability is only just representing just the short term cash flow restrictions that are the result of the cyclical nature of the business. You want to make sure you understand what those maturity obligations are because that is going to be whether or not you're going to look at it as short term or long term, and whether or not it is something that needs to really be taken into consideration. It is not only the nature of the uh, classification, whether it's current or long term, but it's also what was its purpose. So you may regularly see a higher level of current liabilities in certain areas, in certain quarters of the year, because of the cyclical nature of the business. Now, that's going to wrap up this second mini lecture. And I do know that these are very short, but I'm keeping them that way on purpose so that way you can tap them as needed. We'll go into talking about interest bearing notes and non interest bearing notes in the next lecture. And in that particular one, we have some illustrations and we'll work through things. Uh, so please bear with us as we move through this chapter. Thank you and see you at the next lecture.